In this video, guys, we'll look at the pros and cons of selling calls as a trading strategy. Stay tuned. Hey traders, warm welcome to you. So selling calls kind of got a little bit of a limelight at the moment with some of the funds that have been damaged by it. A lot of retail traders are swearing by it as a great income generating strategy. So I thought it was worth doing a video just on this strategy as a whole. If you're interested in options, go and check out an options series that I've done on the channel. We talk about different types of options, puts, calls, buying them, selling them, all those different things you can do. This is specifically the pros and cons of whether you should consider selling calls as a trading strategy. Now, no recommendation as always, just for information purposes, but let's look at some of the upsides and downsides potentially of this as a trading strategy. So a very quick recap, so we can do it in less than 30 seconds. A call option is the right, but not the obligation to buy a share at a specific time, at a specific price point in the future. So a $50 call option, December $50 call option on ABC stock gives you the right, but not the obligation to buy ABC stock at $50 in December, whatever that time may be. Now, if you're selling that, you are selling the contract to the person who is the buyer of the call option. So you're basically taking the other side of the deal. So you basically sell that contract, and that contract has a value. That's the value of the option. That's the price of the option determined by volatility, by time, by interest rates, by price, by time to expiry, all those things. Like I say, go and check that out if you want to kind of dig into that a bit more. But we're looking at it from a strategy perspective. So when you sell that call option, you are getting what's called premium in. This is why it becomes so popular, because you are collecting premiums, almost like you are selling an insurance policy. Maybe not so much for calls, generally for puts is a bit more insurance, but it's almost like what it is, because you're receiving a premium and you only have to pay out as the seller of that option, of that contract, if that occurrence happens. But unfortunately, as more of the occurrence happens, i.e. above $50 in that example, you're gonna have to pay out more and more and more and more. So let's not go into the intricacies of the expense of them, etc. Let's look at them as a strategy. So obviously the biggest kind of draw that people have to this strategy is the high expectancy. You know, most options will expire worthless, and if they pick the right option, if you pick the right option, you're selling the correct call option, then most of the time you're going to generate money, you're going to generate income. That's why it's called the income generating strategy, because if you're selling the right call option, then every time you sell that call option, you're generating income from the premium. Now, of course, there's no free lunch, and you have got the offset, the risk that you might have to pay out. We'll look at that in a second, but that's one of the pros, is the expectancy of the game. People who like to win often, if you like, find this strategy far more amenable because they are winning often. The next thing, the pro obviously, is the leverage. You know, we can trade and we can sell call options, slightly less leverage than if you're buying a call option, because you're gonna have to have some margin. But in terms of the return on your investment compared to, you know, let's say any traditional form, this is pretty decent, because you're getting a decent premium. Yes, you have to put up more margin when you're selling a call option for sure, because of that potentially unlimited risk we'll come to in a second, rather than buying a call option. But when you look at it compared to some more traditional things, perhaps outside the market, then it becomes quite attractive. Number three, is the flexibility. So very, very flexible. There are, you know, a sea of stocks out there that have, again, multiple, if not hundreds of strike prices and expiries, and all different permutations. So very, very flexible. You can trade a stock one day, commodity the next, the currency pair, an indice, whatever it may be, and you can choose how far to go out in terms of your call option. So it's very, very flexible. It's a lot more flexible than perhaps just trading on the direction of an asset. So loads of choice there with that. The other pro I've put in here is the time decay, and that works in your favor. So rather than working against you, which it does when you're buying an option, as the time starts ticking away, the chance of that thing happening that you've bought becomes less likely. That's good for you as a seller. So if the price just stays exactly where it is and nothing happens, you're going to make money every day that happens, because the price of the option gets cheaper and cheaper and cheaper as the time to expiry gets narrower and narrower and narrower. And if you can imagine, the chance of then that actually happening, or the strike being hit, becomes less and less as time decays. Now, there's a certain point where it really starts to tail off, and again, that's kind of more of a deeper strategy assessment, but that it really works in your favor when you're selling call options. So it's quite good for people who think that, hey, you know what, I want to kind of make money if the market just sits there and does nothing. They can sell options and do it that way, which you couldn't do if you were buying or selling traditional stock. Okay, so the other thing is you profit up front. I say profit in inverted commas because you collect the premium up front and you get that straight away. As soon as you sell that option, you collect that premium. Of course, you're liable. It's not free money. You don't just get it to keep it. You've got a contract, and until that contract expires, you're liable for the outcome of that contract. But that can be quite profitable, quite encouraging for traders of these selling call options. And the other thing is you can close at any time. So rather, as opposed to some other type of options, you have to stick in it right till expiry. With your selling call options, traditional call options on the US exchanges, regular options, you can close at any time. So if you get a quick profit, let's say the market moves in your favor, i.e. you'll be down if you're selling a call option, you could close it out and say, thanks very much, I'm gonna take the profit on that. That's probably worth iterating, guys, is that if you're selling calls, you basically have a bearish or neutral bias on it. So you'll make money if the market goes lower or if it stays where it is. If it starts to go higher, that's when you lose money. So this is when we come into the cons. There's not many cons, but they're big, so they do offset the pros, and you have to weigh it up as a commercial decision for you. So the cons are, you've got a high tail risk. What do I mean? If a call option is the right but not the obligation, well, a buyer of a call option has the right but not obligation to purchase shares at a specific price in future. If that price is way lower than the current price, they will exercise it. So say you've got a call option at $50, the price suddenly shoots up to $500. You as the seller are on the hook for $450 per option that you've sold. Your risk is unlimited, and that is the big con with call options. If the price spikes, which we've seen recently with some of these funds who are running these selling call option strategies, if out of nowhere volatility spikes as well, price spikes, the call option is going to rocket in value and you are going to be on the hook for that. So there is a big high tail risk. Yes, it's nice to be able to regularly kind of use these to sell and get income and have a high expectancy, but every so often you're going to get smashed by this, and there's not much you can do about it. Yes, you can manage them and you can adjust them, but if it comes out of nowhere and catches you out, you are going to be on the hook for it. So that is the big con. The other thing is relatively complicated. When I say relatively, I mean compared to picking a long or short on a stock, which is pretty easy. Is it going up or is it going down? I'm going to buy it, or am I going to sell it, or am I going to stay out? That's it. Complicated in terms of what time, how far time do you go out, which stock are you going to pick, what do you need to worry about, what do you need to look at, what's going into the price of this, how do you judge whether it's overvalued or undervalued. There's lots more to think about rather than just the direction of the stock. You could get the direction of the stock right, but if the volatility increases, you could still be on the hook for a loss. There's a lot more to think about than just pure direction, so it can be relatively complicated. And the kind of a similar thing here, guys, is the strike choice. You've got such a variety of strikes, and you've got the kind of balance of, well, the further I go out away from the current price, the less likely the call option is to expire in the money, which is what you want as a seller, but a smaller premium I'm getting. So if it's 10 cents, I'm not getting so much, so I might have to trade more options, I have to sell more options to get the premium that I want. Then of course I'm more vulnerable if it does spike up, but then the closer you go to the current price, the higher the value of the call option is, getting far more when you're selling it, but the more likely that call option is to expire in the money and leave you in a loss situation. Now, don't forget, you've still got the premium to cover. So if it's $5, say, you've still got to have, price has got to go, if you sold the contract for $5, you've got that. The stock then has to go above the strike by $5 for you to then be in a loss. So you've got that cushion as well. So it's a kind of, it becomes quite tricky to work out which strike should I have. There are formulas out there. Some people say, 1 standard deviation, 2 standard, whatever it may be. But ultimately, I think it's a decision for you to make in terms of, well, how wide do I want to go? How much risk do I want to take on? Where do I actually think this market's going to go? What do I think it's going to do? And then putting your thesis onto it and picking an option based around your thesis rather than a robotic, well, I must always sell at this level, sell at this level, sell at this level. That's just my opinion on it anyway. I know people who've had success doing that, but I think that putting your thesis on it and then thinking, well, actually a call option might work because it might just stagnate and drift lower, and that will be perfect for me for my call option. Anyway guys, those are the pros and cons of selling calls. If you like this kind of stuff, a thumbs up is appreciated, and if you're a subscriber, appreciate your support. If you're not, maybe consider doing so if you like this kind of stuff. Take care, see you next one, goodbye.